Okay, welcome back to another episode of an Investing with IBD podcast. It's Wednesday, March 27th. I'm Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily, and I am filling in for Justin Nielsen, who is on vacation again. So this week, we will be talking about the market. It seemingly refuses to correct or consolidate like many have predicted or maybe hoped for. In the ever-wise words of Bill O'Neill, the founder of IBD, we don't predict where the market is going, we interpret the action. So joining me to discuss that all the time on the podcast is Irusha Peiris. He is a portfolio manager at O'Neill Global Advisors. Thank you, Irusha.
Hey Scott, I hope Justin's having fun on these vacations. He's opening up the door, as he said, for you to get in, Scott. So it's
He's
great to
quite
have
the
you on board.
world traveler. I think he went to Denmark and then now he's in Hawaii or something. It's a tough life. He must be doing well in the markets. Let's hope.
Yeah, exactly.
All right, so let's talk about the markets, Arusha. Why don't you pull up when we talk about the markets, what are the markets, right? For us, it's the NASDAQ, it's the S&P 500, and a little bit on the ancillary side, it's the Dow and the Russell 2000. And for some of us, we even go across the pond and we'll look at international markets, but mostly the two heavyweights are the NASDAQ and the S&P. So let's talk about those markets as we sit here today.
Yeah, let's start off with the S&P here. So both of these markets, they're still in uptrends. They're just very consistent, very resilient. Both indices picked up a bunch of distribution over the last few weeks or so, and now they're slowly shaking them off, right? So this continues in many ways to be a lockout rally, and the S&P right here is above all of its key moving averages, right within striking distance of 52-week highs. Scott, do you have any comments on the S&P?
I think what's happening, you mentioned the distribution, which I think is important. We've had quite a number of distribution days. Off the top of my head, I think it's like 5 or 6.
Mm-hmm.
But all distribution is not created equal. So I don't think any of those days are even down more than 1%. In the distribution day, it can be either a stalling day or the market down 0.2%. So the distribution days have been pretty light so far, especially on all the NASDAQ on the indexes, and that's the key is you haven't really had like a shot across the bow or anything of that nature to give you that first kind of warning signal that maybe the market's tired, due for a correction, a consolidation, whatever the word you wish to use for an index that is off its highs.
Yeah, but it almost seemed like on the Nasdaq like a few weeks ago, and I'll switch over to the Nasdaq here, when it actually tested the 21-day moving average. So back on March 15th, we had that a week before. You had that pretty big downside reversal, and I think a number of semiconductors had those big downside reversals, and then we started to break that 21 days. So I think at that point, it seemed like, okay, maybe we're finally going to get that correction that everyone's expecting. But then once again, kind of like all the other times that where it tested the 21-day moving average, the Nasdaq was able to find support and start hitting higher highs.
Yeah, and it's been very subtle, but if you want to play devil's advocate here on the markets, the Nasdaq is starting to underperform the S&P, which for our style, the types of stocks that we're looking to buy, we'd prefer the opposite scenario. So it's very early in that. Again, I don't want to predict, that therefore it has to go down, right? I just want to interpret day by day, week by week. But the most recent interpretation of the Nasdaq last few days is slightly weaker than the S&P.
Yeah, and you see that within technology, right? So if I pull up the XLK here, it's been going sideways for a while, which is kind of underperforming with the way it's been acting. But I think even more important, like software, that has been there have been a number of stocks within software that a number of key stocks that have gotten hit a little bit harder. I feel like the semiconductors have been stronger, but software has been taking a little bit of a break, and you can even see that in the relative strength line here, starting to underperform the S&P for really over what, a month or so.
Yeah, when the market when we had our follow through day late last year, you you had look at that relative strength line for it's kind of built into the price a little bit. Yeah, but you can highlight that it was confirming the strength in this group, and now as this stock, or I should say this ETF or this sector is building a base, it probably will be very difficult for that RS line to make a new high if that were to make a new high. So that'd be interesting. You could get a little bit of a divergence. Now, it is an ETF, so you don't want to read it's not as I don't think the signal is as strong as if a stock broke out without the RS line or vice versa. But these are little things that we use to help with our decision making day by day, just looking at the action in the stocks, the ETFs. ETFs are so important nowadays. There's so much money in that ETF market that it probably should have a third category on interpretation in NASDAQ, S&P, and then the leading ETFs at the time.
No, that's a good point. I mean, speaking of an ETF that's starting to lead a little bit more is the energy, right? And you can see here pattern recognition's drawing a big cup, and it's had energy's been doing really well over the last few weeks.
There are some good stocks in energy. In the third segment, I don't know if we'll highlight any of them, but like I jokingly call Tidewater the NVIDIA of the energy sector because it's just been a tremendous stock, great quarterly earnings and sales. Whether there's been a headwind in the industry or not, this company's just been chugging along, and there's nothing wrong with this stock, whether you look on a daily or a weekly. So the market, I actually think, is much broader than people want to give it credit for. You can own Tidewater, you can own NVIDIA, you could own CrowdStrike, you could own homebuilders, you could own BLD, which is provides. I don't know if they're in the home building section, but they're in the building construction sector. So there's really like at least a handful of really good stocks in lots and lots of industry groups. So I don't really think it's been as narrow as people have. I usually if you're complaining that it's narrow, it's because you're not participating. So I get it. I've been there before, but I think there's been plenty to buy on the individual stock side. If you're only looking for 10, 15, 20 stocks like we would to build a portfolio.
Yeah, and I agree. I feel like it's broadened out. It's been pretty broad for the last few months, right?
Yes.
I'm kind of surprised that people still say that. And you mentioned a number of different areas that have been doing really, really well. And building, it's not just the construction and the home builders, even like AC. Those stocks have been going through the roof too. So there are a lot of there are a lot of areas that have been doing pretty well, just all around besides tech. And today, the IWM, the Russell 2000, had a pretty good day today too, right? So and if I'll go over to the Russell first, the 2000 area, and I'll switch over to the weekly here. The 2000 area has always been that kind of key area, holding the Russell 2000 back for a number of years. But it finally got above it, came back underneath it, set up another little small consolidation. Now it's starting to stay above it a little bit more. And so you're starting to see that go into a little bit more of an uptrend.
Yeah, and I don't like the Russell in the way that it's constructed. I can't recall if I talked about this on the last podcast, so bear with us. Fast forward on your favorite podcast.
Bear with you.
This is a team effort today. Fast forward on your favorite podcast app if you've heard this before. But the construction of the Russell, I believe, even still today, SMCI is the largest component, and I think Celsius Holdings is the second largest. And SMCI will eventually get pushed out because they're now in the S&P 500. So they'll literally take their best stock and move it out and for rebalancing. And the S&P and the NASDAQ, they kind of do the opposite. They let their winners run and they cut their losers. Not quite like we might, but so it's, as I sit here and look at that chart, it's a very constructive chart. It's hard to argue with that. Like if you gave me that chart without the name, I would say that looks pretty bullish. So, and that's another, again, interpretation versus prediction, right? I don't like the way the Russell is the constituents of it. Therefore, I'm predicting it's not going to participate, right? Versus just give me a blank chart or a chart without the name and all that, and my interpretation of what's happening would be totally different. So that goes to show you we all fall for these biases, unfortunately.
Sure. Absolutely. And I mean, you could also put it another way where it's just, look, the IWM or those type of stocks aren't for me. I'm going to focus on what I'm good at, right? Or what works for me. And I'll let some of those stocks just keep passing and keep going. Because in the end, the key, especially using our system, is concentration, stock selection, concentration, and timing, right? And the concentration is a big part of it. And so when you concentrate, you don't have the luxury of participating in a lot of stocks. You really have to pick and choose and try to pick the stocks that really work for you and put a little bit more money into those, if they're
Correct.
right.
I agree. I think I love being in individual stocks, and I know it's difficult to beat the S&P for sure. I get it, but sometimes you can do, I find, as well as the S&P, better than the S&P even in some years with less stocks. So I'm not tracking the alpha or the standard deviation or any of those on my portfolio. But the S&P and the NASDAQ, they have a big advantage over us in that they're always fully invested.
Yeah.
But sometimes that's a disadvantage. So I can be 60% invested and move along. And then if things get bad, I can be 20% invested and outperform. So I think that's one of the reasons why the philosophy, Bill, was always, individual stocks, find the leaders. Why do I need the Excel? What is the ticker for the ETF for software that you showed?
IGV.
Oh, okay. Why do I need IGV? Why don't I just buy ServiceNow or Microsoft, or I could go on and on, right? And so, but I would, in honor of Bill, there's like 3 or 4 things that I would love if he had written the 6th edition, I guess it would be. I would love to have. I guess I would.
Okay,
anyways,
I mean, it was a 4th edition, it's the orange book, but then they have that.
Yeah, I'm counting the green one as the 5th, but that's probably not. I think it was the same, right?
Yeah.
So if he had written another one, that I would be curious about how ETFs, because ETFs have really improved versus when he was doing it. There were a handful of them, and they were all index based. But the ETF world has immensely changed. And then, of course, the earnings announcement has changed as well. And we've, you'll go back in our archive. I'm sure there's plenty of podcasts that we've talked about, how to handle earnings season. That's a whole nother podcast.
For sure.
All right. Anything else you want to focus on?
No, I think kind of the key takeaways from this first segment is that the market's still acting strong, and it's broader than you might realize. And the big thing is that you want to really kind of stick with that trend, and the distribution day count's pretty light, and most of the leading stocks are still hanging in there. Maybe they just still build bases, right?
Good. Okay. All right. So thank you, Irusha. Don't go nowhere. We're going to have a second segment. I was afraid he's going to walk away. Yeah. Yeah. So let's take a break. When we come back, we'll talk about Bill O'Neill's lessons on interpreting the markets, how to interpret versus predict, how to use that today. You're listening to the Investing with IBD podcast. Okay, welcome back to the Investing with IBD podcast. I'm your host, Scott St. Clair, the manager of the Premium Product Group here at Investors Business Daily, and I am filling in for Justin Nielsen. And with me again is our special guest, Irusha. He's here every week, but we got to go with what he provided us. He's our special guest. Irusha is a portfolio manager with O'Neill Global Advisors. Thanks again, Irusha.
Yeah,
So,
Scott, I like when you're forced to say that I'm special. I
Yeah.
think that just makes it all worthwhile right there.
We want to keep you coming back. The people have spoken.
The people have spoken. That's right. Well, thank you, people.
Yeah. So let's talk about Bill O'Neill just a little bit. You know, Monday was his birthday, and since I started the show with one of his, I don't know if that quote is as famous as some of his other quotes, but I know that Scott O'Neill, his son, used to say that all the time in those huddles. So it has stuck with me for sure. So let's talk about the markets and why we don't predict where it's going to go and how we interpret what it's doing at that moment.
Yeah, well, I think really this last year, in so many ways, is a perfect example of that. Just think back a year ago, when we started 2023, uh, where everyone, all the experts out there, and everyone, myself included, everyone knew that a recession was going to happen, right? And of course, what does the market do? It did the exact opposite. The market has had this great rally. Yes, it was more narrow at that time, but in the end, I mean, it was pretty fascinating to watch it throughout most of 2023 because you still saw a lot of very smart people out there digging their feet in, saying, "Nope, we're still going to have a recession. This is just a bear market rally. This is all going to collapse," and they had 1,000 reasons why, and they're all very sound, logical reasons. But in the end, the market's going to do what it wants to do, and that's when those are just one of those many lessons that we've learned from Bill. Happy birthday, Bill. I mean, it was on Monday, his birthday, and uh, I just remember, Scott, like when we would go to Scott and I we would beg to go to the master's programs when Bill O'Neill did it, like 14 years, right? It was 2010 we went to the first one together,
That
right?
was the first one for me. Yeah, I
Yeah,
think
we were.
you had been as
I
a
went actually as a customer too, but
yeah.
we were like begging to go, and I mean, this is on weekends, like 2 days weekends, and here we are. Scott and I were like, we want to spend our weekend, listening to Bill go, and everyone else thought we were crazy, but and we were so. I still remember how excited we were, but Bill was. He kept emphasizing all these seminars that we had an opportunity to go and listen to him. The market is always right. Yeah, every other thing is your opinion. Opinions don't matter in the market. The market is always right. And so when we got that follow through day in the early January 2023, when you saw some stocks working and all this kind of stuff, you know, the market was telling you to start putting some money to work, right? To start changing your mindset and listen to it and go with the trend at that point. Maybe you don't have to be that aggressive or anything, but to listen to the market and not to listen to everyone else's opinion, including yours, because things were looking pretty bad at that point. And it's very normal and very human to be very emotional at that point and be fearful. Why would I want to put it when everyone's going to be losing their jobs? Housing's going to collapse. Banks are going. I remember that was terrifying. It was a year ago, right? Where all the banks, I mean, the regional banks and what Silicon Valley Bank was going on, and there had the bank run on it. I mean, and what First Republic. I mean, it's terrifying at that time. But the market was able to hold, and then you got another fall today. You started seeing more stocks break out and more momentum coming in, and in the end, the market is right. It didn't matter. And that was a tremendous lesson.
Yeah, it's one of my favorite quotes, and it's not me. It's just one of the many quotes that I've stolen from somebody is 27, 28, 29, right? Remember we would joke
Yeah.
and I said that was going to be my book. The
I thought that
problem
was
with
original, though, Scott. That was
no,
going to
no,
be your first chapter in your book, 20,
well,
and it was
and
already
the
sold.
only chapter because it's if you just keep it that simple, and I took this from Edward Topple, I believe, who wrote Zen in the Markets. I'm fairly certain it's in his book, and he says if you can just know that 27 is less than 28, that 28 or that 29 is more than 28, then you can invest in the market because the feedback from the market is really simple. If you paid 29 and the stock's 28, you're down on it, and if you paid 27 and the stock's 28, you're up on it, right? And so you really want to just let the market give you that feedback. And I'll tell you, is because I have a lot of experience in the market, tremendous experience. I've sat in front of the markets and watched hours and hours of markets. They talk about 10,000 hours, Arusha. I probably have 1,000,000 hours. I don't know. It's probably ridiculous.
You might be right. Yeah.
Yeah, but that's not. Sometimes the more experience you have can actually start to hurt you, because then you develop this sense of like, I know, this time it won't, I remember that one time that I took the loss and the stock came back, or I remember that one time I did this and that. And it can be to your detriment. So you have to really just learn to go with what the market's doing. And remember, the US stock market especially, like, we have clients all over the world, as you know, when you were with us, and in the US, there are a zillion eyeballs on the US stock market, and they're all voting with their money. So, and it's sovereign wealth funds. The Swiss National Bank owns, like, a 5% position in Apple, and they own Nvidia. So all this money is either coming into these stocks or coming out of them, and they leave footprints, like Bill would say, elephants in a bathtub.
Yep.
And so you have to learn to respect that price action. It's not perfect. I get it. The market can give you some head fakes here and there, but in the end, if you're much better off in the long run, just kind of respecting the price action of the market versus what you think, because you're not gonna. It's going to be very difficult to be bullish at the lows or bearish at the highs.
It's so true. And Scott, going back to something you mentioned earlier, where about previous experience, I saw, and I'm sure you saw this study too, but there was a study on when you started investing in the stock market, if it was during like a bear market or something, it was just that kind of first impression you had with a market. It was during a bear market, you were a little bit more naturally cautious for most of your investing life. But if you essentially grew up investing in a strong bull market, you're much more aggressive and more optimistic and things like that. And I definitely can relate, because when I started, it was really like the 2000 bear market. And so those kind of impressions kind of leave, those first impressions still have an effect on me sometimes, where when the markets pull back, when you see that distribution, when you see some of the leading stocks break key support areas, immediately I'm thinking I have to protect money at all costs, which in many ways is a great rule to have, because I learned how to sell very quickly during bear markets. But sometimes I get a little too cautious by leaning on those initial memories of the market.
I definitely have that problem, because between the 2000 top and the great financial crisis, I think, was the one that scarred me more, because the 2000 market was toys.com, and what was CMGI, which is an incubator for a lot
I'm talking about kind of like that whole 2000 to 2002 bear market kind of thing.
Yeah, well,
right?
Yeah, that was a pretty tough bear market for sure. But I think for me that it was the 08 one that was a little bit stronger, because it was the Citigroups and the GEs of the world, AIG.
Yeah.
These are like quote unquote real companies, and they're all in trouble, ready to go under. And so that one has weighed on me for a number of years. And I tend to have, a kind of a shoot first, ask questions later mentality, and get into protection mode much sooner than most people.
Which isn't a bad thing to have.
I'm very aware
of it. Yeah.
Yes, thank you. It's funny, we are the same wavelength, Irusha.
Yeah.
I'm aware of it. I know I have a tendency to get bearish faster than probably need be. So when I'm doing that, it's like I'm thinking, if I step outside myself and say, okay, Scott, this is how you're feeling. Remember, it doesn't matter how you feel. What's the market telling you?
And do you have any other kind of rules in addition to kind of those reminders? Like maybe have you instituted any kind of rules that to try to keep you in a little bit longer than maybe your natural tendency might, force you to sell a little bit more?
I've gotten a lot better at it. I'm not as good as like some people probably are, and as good as I'd like to be, but I have learned to kind of go with the flow more and accept. It's hard for me in size, so I tend to reduce, but I can keep a 5% position of XYZ because it hasn't done anything wrong. But I want to sell it just because it's gone up a lot, and I love to ring the cash register. That's it's so much fun to buy something at 100 and sell it at 120.
Yeah.
So I have to fight that urge, and so if I don't allow myself some process of selling some, then I'll make a mistake I found and sell it all in a weird moment. So I do allow myself to reduce.
But that does remind me of another lesson that we learned at those masters events when Bill spoke. He said for every big winner that you get, you should have sold another 3 or 4 stocks, meaning at 20%. Meaning you should be taking most of your gains at 20 to 25%. Not everything is going to be a big winner and things like that, but maybe you have one, you have a lot of conviction in it, you really know the story, and you manage it well, and you get that big winner. But for the most part, you should be locking in a lot of your gains when you have that chance.
I agree. I find my experience with so many clients and people I've spoken to in markets is I had XYZ. I was up, so much, and I gave it all back. Right. And I don't have that war story. I have the opposite war story. I was in NVIDIA, sold it at 600. Now it's 900. So, we all have our kind of personalities, but in honor of Bill and rules, one of Bill's famous sayings is rules, is I for every 4 stocks that I have a profit on, that I'm profitable on, I force myself to pick one that I think could be a big winner, and I give that one much room, and I'm willing to let that one give back a lot of the gains if it does, because I'm going to take the profits like you mentioned, and the other 3. And this has helped me to stay the course. I'm not always going to pick the one that's going to continue up. That's another, everyone would love to know, show me which ones to sell up 20, 25% and which ones to keep.
Yeah.
Wouldn't we all love to know that? But you just got to kind of know based on, again, what would Bill say? Is that company changing the way we work, live, or play? What are the quarterly earnings like? Earnings, he absolutely loved earnings. We've talked about the Alibaba story, how we were all loaded up in Alibaba, and he was like, I don't really, where are the earnings? The earnings were pretty stagnant at that point. And we kind of all looked at each other at that event like, uh-oh. And he was right. This was really early in the Alibaba story, and we were all buying.
It just came out, right?
It was an IPO base. Yeah.
Yeah. I'm trying to find
exactly
on the market charts here.
Now, it ultimately went a lot higher, but who would have been able to withstand the correction that it went through? I think it went down in half.
Yeah, maybe it was around here. It must have been like 2020, 2014, 2015 time, and the earnings line was going down, and so they pulled it up, and everyone was in it, as Scott said, but the only one who wasn't excited about it was Bill. And immediately, I think it was like that day, on that Monday, the stock started selling off, which was kind of crazy.
Yeah, very much etched in stone in my mind, because I remember I had a big position, and this was on a Sunday, and I was thinking, what's going to happen Monday?
Yeah. Well, Scott, let me ask you this, because we used to. Well, I know I've gotten this question a lot. I'm sure you have gotten it too. But can you learn? Can you review these lessons that Bill taught us enough? Is there like a time where you're like, I've heard it before. I don't need to ever hear it again?
Well, not for me, but I always preface that as I'm kind of a stock market junkie. I just love it. I love the puzzle of it. And I couldn't even tell you how many times I've read How to Make Money in Stocks.
Yeah.
In 25-year time frame. I've probably read it at least 25 times, if not more. And we would go to, we went to every single seminar from 2010 to when it stopped in maybe 19-ish, I think. So yeah, not for me. I think it's like riding a bike. You could get rusty if you don't do it for a while. So you have to, and the market is so dynamic. You really have to be, practicing this.
Yeah, a lot of times the way I would answer that question when I would get that is one of the main reasons that and Scott and I used to do the trading summits along with Justin Nielsen was one of the other speakers, but we would travel the country doing the trading summits. And one of the reason I think one of the big motivations for all of us is being able to teach kind of those core principles that Bill taught us. And in many ways, while we were saying it, and I remember being on stage and saying it, a lot of times I was just talking to myself, just and reminding myself of these rules because it's easy to sometimes forget one detail here or one detail there. But it was always good to take a step back and remind, okay, this is why we're doing this. This is why we look for these type of companies. This is why how we enter and exit a certain way. And so I always like doing kind of those trading summits just to review and remind myself on, stick to the fundamentals, like the Vince Lombardi, it's all blocking and tackling. It always just comes down to that. If you stick to the basic kind of core fundamentals, you're never going to get yourself into too much trouble.
All right.
Did I leave
Anything?
you speechless, Scott? I
Yeah.
kind of left you
For the
speechless
first
there.
time ever. Yeah. For the first time ever, you droned on and I had to listen. Thank you. Thank you. Good payback. So you only owe me 99 more, I'm sure. All right. So let's take a little break here. We will be back. We'll talk about some stocks that are on our radar. You're listening to the IBD podcast with Scott St. Clair, filling in for Justin Nielsen, and of course, our special guest, Irusha Peiris, portfolio manager, O'Neill Global Advisors. Okay, welcome back to the Investing with IBD podcast. This week, we're discussing the problem with predictions, why it's so difficult to predict what the stock market will do, why we prefer to interpret what it's doing at that very moment. Friendly reminder, next week, we have a very special guest, more special than Irusha, in fact, Mike Webster. He is the new senior market strategist at Investors Business Daily. So we'll have him on the podcast. I'm sure he's been on many times before, but in his new role. This week, of course, we have Irusha joining us as always. Irusha Peiris, O'Neill Global Portfolio Manager at O'Neill Global Advisors, I should say. So let's talk about some stocks that might be actionable, maybe not at this very moment, but that are on our radar.
Yeah, so Scott, I thought maybe we'll start out with a popular one. I do own shares of this, but this is CrowdStrike. I have it here on the weekly chart, the Market Surge weekly chart, and it's had this amazing run. And really, for the last few weeks or so, it has been going sideways. And it's not a clean base or anything, but it at least is slowing down. The volatility is decreasing, but still finding support and staying above that 10-week moving average. So one that is worth at least putting on the watch list, maybe, and waiting for it to set up a little bit. But Scott, I mean, any thoughts on this?
Yeah, I think it was yesterday. I almost bought it. I had the order queued up and everything because this is my favorite name in the software security group. And one thing about CrowdStrike, like if you go to that weekly chart, well, there's two things that jump out at me. But one is that I've experienced is CrowdStrike rarely builds a base. So if you're waiting for a cup with handle or double bottom to buy CrowdStrike, you might be waiting a long time. It's just one of these weird stocks, the way it trades. The best base on here is that flat base that didn't work. It would have stopped you out. Yeah, right down there. And then you see how it came back so fast, so strong. So you have to kind of buy this one, at least my experience, unconventionally. So that's why I like off that 10-week line that it looks like it's getting very close to, but also the earnings line. Look at the consistent kind of upward drift of that earnings line. Very strong earnings action. And I'm not a computer cyber security expert by any means, but I would guess that this is not an industry that's going anywhere. In fact, it's probably only going to get stronger and stronger. And these guys are, one of the leaders in that group.
Yeah, I mean, there is a lot of strength there. I mean, that is really interesting about it's an unconventional kind of entry, and it really has only formed one base uh, since 2023 here. But one thing, Scott, that is what that you mentioned about the computer software security. There were a number of names out there that were doing well, and they all kind of fell by the wayside, right? Where they all got hit, like Palo Alto got hit really hard. I think Zscaler
Yep.
sold off, right? And so, just assuming that, yes, we know this large trend in software security is going to be there and it's going to keep growing, and more companies are going to need it, but doesn't necessarily mean that every stock is going to just keep doing well. Some stocks are going to disappoint and give those sell signals. And it really gets back to one of those lessons that we learned from Bill, that if it gives you a sell signal, you have to act at that point and protect yourself, because you have no idea how far any of these can go. Uh, Even though they may be great companies, they just might not be great stocks at that time.
All stocks are bad unless they go up, right? As Scott O'Neill would say. So, and I'm sure he took that from his dad. It's one thing that is I like about CrowdStrike is it's not me. Back to the interpretation here, right? It's not me predicting that CrowdStrike's the leader in the group. All I'm doing is interpreting what's happening. Zscaler, Palo Alto, Sentinel One are
Hmm.
all 25% roughly off of their 52-week high. CrowdStrike is 11%. So the market is voting, and the market, to me, at this point, is voting and saying CrowdStrike's the leader. Therefore, that's the one that I focus on.
Yeah, and then one more thing before we move on to the next stock here, Scott. But I was looking at some of the markups from Bill this past weekend. Some of the old, I ran into one of the old master's program books, and it was interesting. There was one stock that he highlighted that didn't have a base, but what he was highlighting was like, look how over the last 4 or 5 weeks, where the stock seemed to close around the same range. It wasn't necessarily a 3 weeks tight that pattern recognition will pick up, and we always talk about. It was just a little bit it was an unconventional. It was more subtle, where it's closing all around the 330, 340 range here on CrowdStrike. So that, in many ways, even though it's not necessarily base, there is some. It seems like the stock doesn't want to necessarily go down just yet, right? It's just kind of all slowly hanging around there, and so we'll have to wait and see how it acts after that. But that maybe is a subtle sign of accumulation or some support.
For sure, I agree. I think it's holding up really nice, not only versus the group, but versus the market as well. The relative strength line is a little bit off the highs, but hanging in there. If this stock were to go up for a couple of weeks, you would I think that RS line could be within new highs within a handful of days. All
So
right,
should we move
let's
to the
jump
next
to the
stock?
next
Yep.
one. Yeah, let's do the home builder DHI.
All right. So yep, just pulling up DHI. So the one reason why we decided to go with DHI, the home builders have been incredibly strong, and if I pull up XHB, you can see that. I mean, it has just been a very strong trending ETF for quite a while here. Reason why we wanted to bring up DHI was this seems to be the one that's actionable at this point. In my opinion, and we already went over what opinions really matter.
I was
This
just
this
about to call you out
I'm
on
not
your
going to give you. I'm
opinion.
not going to give you that opportunity, Scott. But yeah, so I kind of view DR Horton as maybe a second tier home builder on a technical basis, right? It's not fundamental focused at this point, but on a second tier on a technical basis within the home builder group. Because when I think of kind of the leaders in the home builder group, I think of like a Toll Brothers, which I do own a position in, or I think Lennar just started Get Out, but Pulte, PHM also. It's another one they've already broken out. They're kind of already up there. They're already at 52-week highs. But now here comes DR Horton, which can do well. A lot of these home builders do travel together. They can, and they all kind of trend in the same way. But DR Horton
Yes.
is at least actionable right here, right? So it is an opportunity for those who maybe didn't get into some of the other ones to say, you know what, this is my chance to get into one of the biggest home builder, I think. It broke out, and they have earnings in a few weeks here, but it's actionable, and you can get some exposure and see what happens.
Yeah, one thing you said that I've experienced for sure is that the home builders are very similar to like gold stocks. Like they tend to all kind of build the same patterns. Some of them act a little bit better than others, but if you're doing well in Toll Brothers, it's unlikely you're not going to do well in PHM or DHI, and vice versa. You know, if the whole group is going down, it's going to be difficult for you to find that one home builder that's defying logic in the, because that home building sector, the industry, it's very much has these macro headwinds and tailwinds that play a role in moving these stocks.
Yeah,
Okay.
and so 3% away from the pivot, so it is actionable at this point. I mean, the metrics, the EPS rating, composite rating, relative strength rating, they're all pretty good here. And so this is where sometimes where I'll say, see a stock that looks pretty good, and it's like you take a shot, see what happens. If it stops you out, it stops you out.
Exactly. Yep. That's your it gives you the freedom to take a chance on a name you like, because regardless of how you buy it, CrowdStrike, if it goes down X amount, you want to protect yourself in our world. And so sometimes we wait around for the perfect buy point and then watch the stock go up and up and up. It's frustrating. It's happened to me before. It's like, why don't I just buy it? And if it didn't go well, then I'll stop myself out. Might take a few tries, but that second or third try, those have been very profitable in instances. All right, let's turn now to Southern Copper. The ticker is SCCO.
Yeah, this one it already is broken out. It's already extended at this point on a weekly chart. Let's see how it closes. I mean, we have one more trading day this week, but maybe it puts in a 3 weeks tight pattern here where it's essentially gone sideways, closing around 104, the 104 area the last few weeks. So there's a chance there. It gave the power from pivot flag where it's up more than 20% in 3 weeks. So showing some pretty good power there. The relative strength line's strong. And I think the bigger thing here is that maybe commodities are getting a little bit more in favor.
And I'm glad you said that, because that's the key. Because I hear a lot of talk on Twitter that maybe, it's commodities' turn to participate. And that makes sense to me. I can conceptually see that commodities have been in a bear market for a long, long time, but I want the market to tell me that it's time to go in commodities rather than me picking the low in natural gas or something like that and just getting run over. You're finally getting some strength in this area, and copper is a really key commodity, of course. So I like the action in this stock. I think it's very compelling. It's just now it's like, how do you enter it? And what's the best way to build a position in this? I own TECK, which is in the same group. If you go to the weekly chart on Market Surge, it's going to give you the the 5 best relative strength stocks in that group. This is a little Market Surge commercial in between here, Arusha. If you see something like Southern Copper, I always go over and look at that, because I might say, what else is confirming the strength? Or let's say I owned FCX and Tech. It'd be like, do I really want a third stock in the money metal ores group? Probably not. Therefore, I can just pass on Southern Copper. So it's a nice time saver in that regard as well.
Yeah, I mean, that definitely can point you in the right direction and confirm a lot of times with industry groups. If you're looking at one stock, usually, and this is one of those rules that we learned from Bill, there should be another stock that's doing pretty well in that group. Or sometimes it's hard to just go with one stock, and if the industry group's bad and not a lot of other stocks are participating, you might have the odds going against you at that point. But get one thing I wanted to highlight with Southern Copper on the daily chart, and we'll continue this Market Surge commercial here, Scott. But it is picking up an ant right? Just one ant, right? So maybe there's one ant coming to the picnic at this point, but you have the 20%. You're getting an ant. And so I think the other key thing that you said was now you have to let it set up. You have to be disciplined and let it truly set up so you can manage your risk.
Yeah, I do like that showing that, it's giving you that signal of strength. That's not a sign to run out and buy it, but it is marking that strength that this stock came up on that right side, 20% move plus. Volume has to be there for the ant to show up, and so yeah, it's a nice little new feature you can add to your toolbox. Okay, well, thanks again, Irusha Peiris, portfolio manager, O'Neill Global Advisors, all around good guy. Everybody knows that, unfortunately. So it's always a pleasure we used to do webinars together and all that, and I sure miss those days. We'll have to have you back on a market surge webinars. How about you and Mike Webster? That
might be fun, but
that would be quite chaotic. So
that would absolutely be chaotic. But thanks, Scott, for taking the time to cover for Justin, who seems to find more vacation days than we knew existed.
Yeah, I think I don't know if I should check with HR or not, but it's sure either. And then we were talking off camera. He must be doing really well on the market because the guy's been to Europe, and now I think he's in Hawaii. And it's a tough life being Justin Nielsen. All right, that's all for this week. Thank you, guys. Next week, like I mentioned, we do have Mike Webster. He is the senior market strategist at Investors Business Daily. We're welcoming him back to the family. It's awesome to have him back. Justin Nielsen also returns, so not as exciting as Mike coming back, but he'll be working alongside Irusha Peiris, of course. If you like this podcast, you can find it on all your iPhone and Android phone podcast apps. But you can also find it at investors.com/podcast. The nice thing about that is you get to see the charts, get that feel for what we're talking about. So investors.com/podcast. You can also find any archived episodes that we've had and articles as well. Thanks for tuning in. My name is Scott St. Clair, filling in for Justin Nielsen, and we appreciate you joining us today. Have a nice day.